Welcome to It's the Economy. Under focus is the global economy. Now, global economic growth is likely to surprise on the upside, despite the 400-500 basis points rate hike taken by most advanced major economies over the past 2 years. And the jury is still out on whether the US and the world economy will manage a soft landing. That's the sum and substance of some recent reports by Paul Gruenwald, the chief economist, global chief economist at S&P Ratings. Paul today joins us to examine how the world economy is shaping up and whether he spots any headwinds that can slow down India's scorching pace of growth. Paul, good morning, and thank you very much indeed for your time. Actually, I want to speak about various regions of the global economy, but today what compels our attention is the Chinese economy. The leaders have gathered to perhaps announce a set of stimuli for the economy. It's a much-awaited meeting in China. What's your expectation from this meeting itself? Should one expect some fiscal and monetary boosting steps?
Well, first, the Chinese authorities over the past few years have taken a much more measured approach to stimulus. We can all remember back around the time of the global financial crisis, where there was an enormous stimulus that raised Chinese and global growth. But during this particular slowdown with the property market under stress, they seem to be much more precise and measured. So we'll see if anything comes out of this session. China's trying to balance fixing the property sector and making sure those homes get built with making sure there's a sufficient financial discipline in the sector. So we'll be watching to see how they balance those two concerns. Okay.
Well, just a little more on China. What repeatedly economists tell us is that China is likely to be a disinflationary force because at the moment they are still investing in manufacturing. Yes, infrastructure is the one that's created all these ghost towns and property problems, but China's surging full speed ahead in manufacturing. Your thoughts, is it likely to continue to be a disinflationary force?
Yeah, I think disinflationary is the right word. We have some difficulties with calling it deflation because the deflation is actually happening in a small number of sectors, particularly food. But and outside of the housing slowdown, there's decent demand in China, but they clearly have a demand problem. They clearly have a confidence problem. We still think they can pull, a 5-ish% growth this year. But again, we're watching to see if we're going to get some more stimulus out of the current meetings in Beijing.
Okay, so does China be a disinflationary force for the world, as in terms of iron ore, steel, and even manufactured goods? Apparently, they're manufacturing at a feverish pace for the global economy. Does that continue to keep prices down for the world, manufactured as well as raw material?
Yeah, it does. It does in some sectors, but let's remember the global challenge we're facing on inflation is actually services and non-tradable. So if you look at the major central banks, they are seeing lower inflationary pressures on the goods side, but it's really the services side where we're having the inflation problem. So yes, China, I think, has historically been kind of a strong manufacturing and even perhaps an over-manufacturing economy, putting downward pressure on goods inflation. But the real concern continues to be services inflation for the major central banks.
Okay, no, I take your point. But I'm persisting with that question only because in India we are facing absolutely lower and lower core inflation, and it's only food that's kept inflation higher, and India worries that core inflation may start looking deflationary. But I'll come to India in a minute. Tell me about how you're interpreting the US economy. A lot of jobs data, the JOLTS data, non-farm payrolls, everything is due later this week. But are you sensing that it's going to be higher for longer in terms of rates? And how do you see US growth itself? That's the one, as your report puts it, has been, hugely surprising on the upside.
Yeah, that's right. There's been a huge surprise from the U.S. growth. We've seen all major central banks, as you noted, raise policy rates by 400 or 500 basis points. We were expecting that to slow demand. We've seen that in almost every advanced economy except the U.S. The U.S., we just raised our growth forecast, as you mentioned, up to 2.4% this year. A couple of reasons for that. One, investment seems to be quite robust in the US. Part of that's public with the Inflation Reduction Act, but that seems to be crowding in, not crowding out private investment. And also we see very robust small business formation in the US. And on top of that, we've got a lot of fiscal juice or stimulus in the tank. So that's powering US growth. And it's now outperforming the advanced economies by a high margin. And to your question on rates, we've thought all along that the Fed's going to be cutting cautiously. So we maintain our view that we probably get our first 25 basis point Fed funds rate reduction in June and maybe 2 more this year. But we think the climb down from the current level of policy rates in the US is going to be gradual and take some time.
Okay, just a word more on the US Fisc. I mean, they are staring at a debt ceiling and a shutdown. And the latest that's come out over the weekend is that some kind of a package is in the offing to allow spending up until September. I mean, up until the elections, I would assume. But what's your reading? You think the Fisc will lower at all in an election year? And if it doesn't, are we going to see higher yields in the longer tenor because more paper is going to be issued?
Yeah, right. Well, the U.S. has this unusual, I guess, split between the spending decision and the funding decision. And as you mentioned, there are now discussions in Washington. That particular system is kind of tailor-made for drama. So we've seen this movie before, and it's usually the case that, cooler minds prevail and we get some sort of agreement. Looks like that's going to happen again. We do not see a big fiscal retrenchment this election year. That's probably true for most countries where you have an election year. But, demand for U.S. treasuries is still pretty strong globally. Demand for the U.S. dollar is pretty strong globally. Yes. So despite the large deficits in the U.S., which are helping growth, we don't see any big moves toward bringing in the deficit in this election year, 2024. We'll have to see what happens in November and then reassess for next year.
Okay. Any view, therefore, on U.S. yields? I mean, the 10-year, which is, of course, the world's benchmark, does it, is for the bottom? Does it continue to surge higher?
Yeah, it seems to be range bound, right? We dipped toward 4 for a while. Now it seems to be in the 4 to 5 range. But again, there seems to be pretty robust demand for the 10-year. It remains, as you said, the world's benchmark and risk-free assets. So, as far as we can tell, at least for now, there's no real change to the robust demand for U.S. government long-term paper.
Okay. Now, therefore, how would you, pitch the global economic ecosystem for India? We had this steaming 8.4% growth number announced for the third quarter. And thereafter, immediately after the announcement, the chief economic advisor, Dr. Anant Nageshwaran, had a press conference where he said the only danger is the global slowdown. So is there a global headwind at all for India?
Yeah, there'd be a modest, I think there's probably a modest headwind for India and quite frankly, other countries, but we're still pretty constructive on India. Our chief economist for CRISIL, Dr. D.K. Joshi's got Indian growth this fiscal at 7.3 and then 6.5 next year. The risk would be a material global slowdown, but what we've seen so far over the past year or so with the large rate hikes, again, is that services spending has held up, labor markets have held up, and the damage to global growth has mostly been on the manufacturing side, and that's more sensitive to interest rates. And obviously, the largest economy in the world, the U.S., is going to be central to that view. So after 400 or 500 basis points of rate rises, of course, we're going to a period of slower growth. But as we all know, India is largely a domestic-led economy. Investment, which has always been the question mark, seems to be going well. So that points to a pretty robust, next couple of years in terms of growth.
Okay, can you repeat? How do you see Indian growth itself? Does next year get better than this year? This year itself, the apex statistical body is forecasting 7.6% for the Fisc, not for the year, for the fiscal year. And what is the S&P forecast for next year?
Yeah, for the fiscal 2024, we've got 7.3, and then we've got 6.5 for next year, and then maybe a bit more than that over the medium term. As we've discussed, next fiscal year is going to be a bit slower than the one that's ending right now. And again, that's the global slowdown. We do expect the U.S. to eventually slow down, but that's contingent on rates higher for longer and some of the steam coming out of that economy. But the global environment facing India is not bad. And again, we've had this period of good growth, and it looks like 6.5 to 7 is our estimate of trend growth throughout the rest of this decade. So that's a pretty good outcome.
Good to hear the number 7. Just a quick last question. You don't see any financial red flags, do you? You allude in your paper to reset of interest rates. And in the US, there is a large amount of fixed rates, and therefore the reset hasn't hit so far. But do you think resets can create a financial sector problem?
Potentially, if they happen abruptly. A lot of folks are focusing on commercial real estate, and we do have some structural weakness there from working from home and other shifts for commercial property. But those resets happen in a staggered period over a number of years. There's not really a big wall where all of those rates reset, and our banking teams are looking at the types of financial institutions, let's say local and regional banks, that have outside exposure to commercial real estate. But their view right now is that it's manageable. There will be a period of rate resets. We call that the maturity wall, and that's going to last for a number of years. But firms know that's coming, banks know that's coming, regulators know that's coming. So we think that this should be manageable for the system, but it's obviously something to watch, especially if rates stay higher for longer.
Okay, and just a last word on crude. Do you expect that to remain under control or throw a nasty shock for economies like India?
Yeah, crude. I saw your previous segment. I mean, we're not, my team is not in the oil forecasting business, but that range of crude prices you saw in the neighborhood of 80, that looks sort of digestible for the global economy. That's roughly our baseline forecast. So as long as we don't get any geopolitical shocks, which is always a risk, we don't see that's going to be a big kind of needle mover for the global macro.
All right. Thank you. Thank you, Paul, very much for interpreting a whole host of global cues for us. Have a great stay in India. It's a pity we didn't have you in the studio.
Next time, maybe.
So that's yeah, sure. So that's the word coming in from S&P. The world could actually surprise on the upside in terms of growth, especially the United States. So, we don't have to worry too much as, global growth being a headwind.